It has been a long time since I put out a video. A long time. I mean, probably a couple months now. But the reason I haven't put out a video is because I didn't have a lot to say because I figured everybody was saying it. Everybody has been, just there's a ton of YouTubers who are on talking about markets, about all this. And so I got bored with it. I got tired of saying stuff, and only way to get you to listen is to give some wild ass projections on stocks or bonds or crypto or what have you. And I just honestly, I got tired of it. So why am I doing this today? Number one is because I don't think people are telling the honest to God truth of what is to come and what is happening. And so that's what I'm going to share with you today. I'm going to probably ramble a bit on stuff. This is probably going to be a very long video, but in the end, I hope you take some good things from it, and you can apply it to protect yourself. And really, that's what this is all about today. So let's get into it. Over the last, couple weeks, couple months, we have seen the NASDAQ, the SP500, the Dow Jones, treasuries all sink. Paul Tudor Jones was interviewed on CNBC recently, and he talked about how it's like you're in a sailboat and you have a current that is you're sailing against is coming towards you, and you're the boat, but you also have this other current that's coming behind you, but then you have another current coming this way. And the probability of those currents actually coming in all these different directions at one time is unheard of. Hasn't happened in the past. And today, that's what we're facing. The bond market has sold off. The equity markets have sold off. The crypto markets have sold off. We're even seeing some currencies starting to sell off. I think it was Hong Kong became unpegged from its benchmark, and just recently. But what it is demonstrating to me is that we've talked about in the past the perfect storm. We've talked about black swan events. We've heard it all throughout the news. The minute you get a bounce in the S&P or the Dow or the NASDAQ or what have you, everybody's like, oh, the bottom's in. The truth is the bottom is not in my opinion. And please, let's just get this straight right up front. This is not advice. I'm not telling you what to do. This is my opinion, and like belly buttons, everybody has an opinion. So take it for what it is, learn from it, use it, trash it, whatever you decide. But whatever you take from this, pay attention to what is happening on a global economic scale. My belief is we're nowhere near a bottom. At first I thought the S&P to 3,600 was a good target. I don't believe that anymore. I believe that we are so leveraged up over the last 20 some odd years that we have made free money. We've given out free money checks to people throughout the 20 some odd years. And we are now at a point where that is starting to come home to roost on us. I believe what we're seeing with the Federal Reserve and their actions with this relentless, we're going to raise interest rates 50 basis points at a time. If you look at the bond market, it is indicating that we'll see 7 rate hikes at 50 basis points. Holy cow. You think gas and oil is expensive now, you just wait. We'll probably, if that is the case and Federal Chairman Powell doesn't ease back and get dovish real quick, you're going to see $8 a gallon, most likely, in my opinion. But what I think is giving us great signs of things that are starting to get really weird is, one, the bond market. 10-year treasury, I believe, got up to 3.25% yield. So if you remember, yields rise, bond values go down, which means people are getting out of bonds. You correlate that over to US dollar, and the US dollar is at, I think, decade highs, 1.04 on the dollar, which means everything in relation to that or oppositely correlates to that is going down. So you're seeing that money leaving high credit quality bonds and going to the US dollar. Why would that happen? Well, it's liquidity. Smart money understands that you pay the majority of your bills in US dollars, and 98% of all transactions on a global scale are done in US dollars. Well, when money gets tight and you have the Fed basically tightening in a sense, they're not buying treasuries markets anymore, they're supposedly, or mortgage markets. And so now you're starting to see people run out of credit or high quality credit like treasuries and investment grade bonds, and they're going to the US dollar, which is driving the US dollar up. As long as that dollar goes up, things become more expensive outside the United States. If you're buying goods from another country or a product from another country and you're using US dollars, your exchange rate's a little bit more favorable to you. But if you're buying goods from the United States and you have to transact in US dollars, and you have to flip your currency from your currency to US dollars, it's getting more and more expensive. So you're seeing a slowing in that case. So countries and institutions are raising cash. Why do they raise cash? They raise cash because they know something is up and it's not good. We saw this back in March of 2019, where we saw the US dollar start to rise. We saw bond yields rise a bit. You saw then eventually April, May, you saw the German 10-year Bund go down, which meant it was a flight to quality. You saw the same thing in the 10-year treasuries. And all of a sudden we got to March of 2020, US dollar goes to, I think, 1.03. And treasuries went, I think, below 0.5, if I remember right. I may be off on that number, but they went real low, which means people flooded in to the bond market, but also not flooded into the bond market. The Fed came in and started buying up bonds and swapping out that collateral of treasuries for US dollars. And that's the repo window, which I've talked about in the past. Well, now you have an environment where the Fed has basically said, we have to right the wrongs of the past and we have to raise interest rates. See, prior to them raising rates in March for the first time at 25 basis points, they had driven basically the 10-year or the Fed funds rate to basically 0.25% or basically zero. So money was super cheap. That's why you saw housing boom. That's why you said mortgage rates boom or mortgage rates go down. And people bought houses over the last 2 or 3 years, and the housing market has been great. Well, now the mortgage rates, 30-year mortgage rates are over 5%, and it's more expensive. There's a supply issue, which keeps prices up, especially here in Florida. But what we're now starting to see is that the Fed has taken this stance, and I think it's a lot of political and basically credibility of the Fed, and that is the last time we raised interest rates, which was December of 2018, the market cratered. They gave in after Christmas of 2018 and started lowering rates again. And I believe they're this time like, we're not doing that again. And they're not going to do it until unemployment goes through the roof, which I believe it will happen in the next 6 to 12 months. When the S&P is at, just craters, which I believe is going to happen. And you see basically the world turn on the Fed and them go, okay, we're not going to raise interest rates anymore. We're going to actually lower them. But from the point of the Fed, I get it, because they have nowhere to go. They have no dry ammo or powder, as they say, to combat a recession or a depression. So they have to raise interest rates, and that's why they're hell-bent on doing so. And I see them go into the next Fed meeting, and they'll raise 50 basis points. Well, that's probably, July, I think? And at that point, chances are you're going to see the Fed or the S&P, the Dow, the NASDAQ, really any market really in the crater, really getting beaten. When you see the 10-year to U.S. Treasury get below, say, 2.67%, they're gonna have to give. And if they don't give, holy cow, watch out below. Because here's the thing. You look at what is happening in the world right now. And when I go, like the first time I really had that moment of, oh crap, can I afford this? Was about 3 or 4 weeks ago. My wife and I drove down to Miami. I went to the Bitcoin 2022 conference, which was very interesting. I'll touch upon that in just a second. And the first time I filled up, my wife drives a Tahoe, GMC Tahoe, or a Chevrolet Tahoe, and the gas pump stopped at $100. And I looked at it, and it still had 2 more gallons to go. And those 2 gallons was going to be cost around $4.50, $4.80 a gallon. But it shut off because my debit card wouldn't allow me to go any further. And I went in and I said to the lady, I was like, is that because there's a limit? She goes, yeah. She goes, it's happening all the time. This happened last time when gas was over $5. And I remember that. I was living here in Florida. And it was like, holy cow. Luckily, I could afford it at that time. But this was the first time a couple of weeks ago where I said, you know what? That's a lot of money. And it continuously becomes a lot of money. And since then, I've restricted my driving. My wife and I drive to the studio in one car now. Well, if I'm thinking that way, can you imagine somebody who has a household income of $60,000? And you got to pay taxes, you got to pay rent, you got to pay utilities, you got to pay to feed the kids, you got to pay blah, blah, blah. And then, oh, by the way, you're spending more and more on gas and food. What does that do to that family? What does that do to their spending habits? What are the repercussions down the line of such an event? And this is where I go, you know what? You think the equity markets have bottomed? They have not. We have not seen anywhere near the bottom, in my opinion. And like I said, it's my opinion. When we start to see money, the dollar decrease, then we can maybe inflation will start going down. But right now the CPI printed 8.3%. But if you factor in all of it, like food and gas, what's inflation? Like 20+%? I mean, we're paying more and more over the last 12 months than we've ever paid for anything in a long time, unless you grew up through the 70s or were paying bills in the 70s. I suspect we are on the verge of another tipping point where, in a way, the Fed has to raise rates, maybe at least 2 more times, because they need something to offset when they have to lower rates. So right now, I believe the Fed funds rate is at roughly 1%. If you go by what the bond market is predicting, that's 7 more rate hikes. That's, 3, that's brings up to about 5.5%, 6%, something like that. Holy cow, if the Fed funds rate got that high, we would be living through the 70s again. Mortgage rates would be well over 10%. Housing would crater. Everything would crater. Oil and gasoline at the pump would probably be over 10. For me, right now, if oil gets over $5, $6, I sold my business a year ago. I don't think I'll be driving anywhere or traveling anywhere. And that's where I think Americans are at this point of, wait a second, if we cross this line, you die. It's that whole like Saddam Hussein thing. You cross this line, you die. Okay, you cross this line, you die. Oh, no, okay. You cross this line, you die. You cross this line, I go, yeah. There's a Robin Williams skit. Look it up on YouTube. It's classic. But the point is, we are getting to a point where it's getting too expensive. You throw in the Ukraine-Russia war. From what I've understand, fact check me on this if you like, but Ukraine is the 4th biggest producer of grains and corn in the world. They have not shipped anything out of their ports in, I believe, over 30 days. So now you have another factor of lack of food on the planet. Now, it's not a big amount they represent. The United States, I believe, is the biggest producer of grains and corn and stuff like that. But when you take out your fourth man and now you're on a three-legged stool, you're start to hurt. The question is, if things get too big, expensive, how do you afford corn? And if you look at it like a chart of corn, it's been going up also. So we have all these things that are happening to us right now that I believe are going to cause more, basically, pain. I heard this reference. I don't know how true this is, but double check me. But Jerome Powell was interviewed on NPR, and he basically said, yeah, there is more pain to come when it comes to raising interest rates. When he is saying that, his intent is to raise interest rates, which is going to drive the cost of everything. You know, I have some buddies who are in the housing game, and they're developers and they build homes and that kind of thing. And here in Florida, there's just a shortage and things are just going through the roof. I mean, the house I bought 8 years ago is now worth like $1 million, which is completely unheard of, knowing who built the house and where it's at and the quality of it. Blows my mind, but big money's coming in and buying cash deals with these houses. But my point is, at some point, this even gets too tight of a noose around the rich people. And as you see that happen, then things rapidly slow. The whole thing is, now you've got that market. So you got the bond market, you got the equity market, globally, you got things starting to slow the whole bit. Then you got this crypto thing. And I love crypto. And here's why I love it. Now I think this is the one thing people don't understand about crypto. And that is, crypto is not about replacing the US dollar as the reserve currency of the world, as it is pitched with Bitcoin. But more importantly, crypto is about the underlying technology that is changing our world. That could, if and when it's done right, will provide seamless and very quick money transfers, payment systems, reduce fraud, even though I know there's been fraud deals in the news and the whole bit, but out of 1 million transactions, there's 2 or 3 every so often. Okay, that happens, but that happens in everything, and that doesn't get reported. But crypto represents the underlying technology that will change our world. And I believe that is what we have to focus on, rather than, it's going to get rid of the central banks of the world or DeFi and the whole bit. In my opinion, a lot of that isn't going to happen. And here's why. The old world foundation has worked for many years, not so great, maybe whatever, but it's been very consistent and very solid. When we integrate the crypto technology along with the existing infrastructure or financial infrastructure, then we have a better machine. But right now there is so much hatred towards crypto, especially with the whole Luna blow up. And I am a victim of that. And luckily, I am able to survive that, and in hopes that maybe Luna gets it all back together and it goes through the roof at some point. But what I think you have to look at crypto as is let me step back. A number of weeks ago, I went to the Miami Bitcoin 2022 conference. And after the first day, I got back to the hotel and I was talking to my wife, and I said, this reminds me of when you and I were in the skateboard industry. My wife rode semi-pro in the snowboard industry, and I was a rep back in the early 90s. And I say it reminds me of that era because everybody and their brother had a snowboard company. They were making boards out of their garages. They were making clothes. They were doing whatever. They were involved, and there were thousands of snowboard companies in the industry. And prior to that, the same way, the skateboard industry. But after 10 years, 11 years, that all got flushed out. And we had a bust economically when the tech bubble blew up, and a lot of those skateboard companies went away. And now today we have a foundation of skateboard companies, a very small percentage of those who existed back in the early 90s that are the foundation of the snow and skate industry. Fast forward to the tech industry. My first venture into the tech was a bunch of friends and I started a best of best of US, not best of US, that's Carrie's thing, but Excel America. And it was a website that you could go on and you could find a directory of financial advisors in the United States. And we put this program together, this website, and we marketed it, and it went nowhere. It went nowhere. And but it was a good basically learning for me. But two, I was one of millions of tech startup companies, big or small, back in, 87, 88 period of time that we're trying to utilize the internet. And then the tech bubble happened and they all blew up and they went away. And then fast forward today, we now have a solid group of companies that are tech companies, that are internet-based companies that have been around, that survived that. But most importantly, what I took away from the skateboard industry, the internet tech bubble world, in relation to the crypto event that I went to in Miami at Bitcoin 2022, was that a group of companies will survive. And they all will survive because they do one thing, and they solve a problem. The companies that stuck around in the skate industry and the snowboard industry, they solved a problem. They were well funded. They had great minds behind them, and they kicked ass. And they could survive downturns. The same with the tech bubble. Companies who solved a problem, legitimately solved a problem that made our lives easier, that could withstand a downturn, all have survived. Fast forward to what is happening in the crypto world, it's the same thing. We're hearing about companies, the Luna experiment is one, because that's a headline right now. It's an experiment in that, I hate to use that word because it sounds like a science class thing, but it's an experiment in that they were trying to reinvent the foundation of pegging a currency, a cryptocurrency world to the US dollar, and trying to do it through an algorithmic new science experiment. Why? Well, like on Yellowstone, the second season, the episode, I think 10 or 9 we watched last night, like a meth lab, it blew up. And now it's basically nothing right now. Will it come back? I don't know. But what it did was it annihilated a lot of wealth, and a lot of people have gotten hurt by it. Like the snowboard industry, a lot of people who put a lot of money into the snowboard industry in the early 90s, a lot of them got blown up. Like the tech bubble, a lot of people who put money into the tech industry, a lot of them got blown up. But with crypto, a lot of people who aren't your typical accredited investor, your typical venture capitalist or private equity, have gotten blown up. And I suspect there will be more. The hodlers of the world, a lot of them are on their knees right now. They're like, well, I gotta go get a job now. I wouldn't be surprised if November's Great Resignation becomes November of 2022's great, here's my resume. I need a job because of what's happening in crypto. But I still believe in crypto. And here's why I believe. It's the technology. It's the streamlining of things. It's the making more efficiencies and more effectiveness. When you're building a business, you want effective, efficient processes. And our world, needs those things. We are graduating. We have the technology and the ability and the intellectual capital to do those things. But there are going to be train wrecks. And because of Wall Street and the ability to create synthetic products upon synthetic products upon synthetic products, we are now having an environment where crypto is so volatile, it moves so fast that innocent bystanders are getting annihilated. I think it was like Luna was at like $82 a share May 5th or something, and last night or this morning when I checked, it was basically 0.0005 of a cent. And all that money, who the hodlers of the world, the holders of the world, got annihilated. And I think this is where I'm coming around to risk management. How are you managing your risk? Are you 100% in on one position and you're like, it's going to the moon? Or are you spreading your assets out? You're watching economic cycles. You're making good decisions. And you have a point where you say, enough's enough. I'm out of this. And you liquidate. One of the biggest things, a conversation I had with a financial advisor here recently was that she said she didn't want to sell something because the clients were going to complain about the taxes they would pay on this. And yet, when it goes to zero, it goes back to the price they paid for it or below, having experienced this, they scream and yell at their financial advisor. If you're using a financial advisor and they're come to you and say, listen, we got a major profit in this. It's overweighting our overall portfolio. We need to take some profits. And oh, by the way, the economic conditions don't look good. Just say, great, let's figure out my tax bill at the end of the quarter after you liquidate those positions or reduce those positions down to an underweight, and I will be happily pay the taxes. Do not go after your financial advisor because you said, I want to hold it. I want to hold it. It's a long-term hold. And then when it goes to where you paid for it or lower and you start screaming, check yourself. You owe that to that advisor. He or she is just doing their best to protect you. But my position is, if I got profits, I take them. And when I'm in economic conditions like I am, we are in today, and there's a good chance that I could be negative in that position very fast, especially if you're in crypto, take the profits and pay the taxes and be done. Quit bitching, quit getting upset about things. Do it. Just do it. Because what we have coming, especially with the derivatives market layering on top of crypto, that hasn't worked itself completely out. I was talking back and forth with a buddy about Cardano, which is a cryptocurrency, ADA, and he's been buying tons of it. He's been buying on the downside. Well, it moved back up from low 40s to 58, 59 or so this morning. And I was like, dude, if you got profit in it, you may want to reduce your position. He's a long-term holder. He thinks it'll be, $10 to $15 a share in the future. That's after, in my belief, it goes to 10 cents. And that is, in my opinion, where you buy it. Now, that's an opinion. It's not a recommendation. Will it get there? I don't know. But the way the world is right now and the environment we're in, there's a really good chance that could be the case. So, I know I've gone on for a while and I've rambled a bit. And honestly, if you have questions for me, you can always shoot me an email at taglivingloud@gmail.com, and I'd be willing to answer questions up to a point. After that, I'm going to get paid, folks. I got to pay that gas bill, right? And so I do charge an hourly fee for advice. And if you're interested, shoot me an email at that tag, livingloud@gmail.com, and I can give you sort of an idea of what I charge and my point of view. At the end of the day, I want to add value, and that's why I started doing YouTube a number of years ago. And why I stopped was I felt like I wasn't adding value. I'm talking to you today because I want to add value. And number one, I want you to be safe, because my 52 years on this planet, I don't think I've seen anything that I believe is coming. And so I believe you should be protected, be aware, make your own decisions. Like I said earlier, my opinion is like belly buttons. We all got one. It's an opinion. It's my point of view. It's not advice. So don't you take this information, go do your due diligence, go do your homework. Any company you buy, any bond you buy, any mutual fund you buy, ETF or crypto you buy, spend some time understanding what they're doing. I heard this guy speak today about, if you look at the high yield ETF, HYG or JNK, if you just opened up the hood and looked at the junk that's in it, nobody wants it. And so the bid-ask spread is widening very rapidly. And that is one thing to watch. When you think it's over, check yourself. Check yourself. All right, that's it. I hope you have a great day. Shoot me an email if you have any questions, and do your best, be a good person, and live loud.